Morning, guys. I hope you're having a good start to the week. I'm just going to show the trade that I took this morning on US 500, which was a long off the ADR model, which was in upwards expansion and following structure, which was bullish. So we'll start from the higher time frame, work our way down. So on the daily, we have both buy side and sell side liquidity always marked out. Sell side liquidity is not prominent in this area purely because it's had a change of character to the downside, interacted with this order block, moved back up and created a change of character to the upside. And we have two buy side points marked out, which have much more buy orders on than they have sell orders, in my opinion. So we move down to the H4. We are bearish on the H4. However, following the daily understanding and how close the buy side liquidity is, we are looking for bullish moves. So we do have this bias and we do have a connection to it. However, when we see the H1, we have H1 break your structure to the upside. So this means after New York on Friday, price is given the intent to fill from the left hand side, which was the bearish move down on the Wednesday, but it is also looking to push up further to fill in these orders short term and potentially long term, fill in the buy side liquidity to the upside. So we move to the 5 minute. This is where we do all our intraday marking. So on the afternoon on Friday, we have this protected low and this breaker structure created. We then have a fail to close at market close just near 4 p.m. So price is playing around up here and it's trying to push back down to grab more liquidity to potentially go up or continue what it's intended to do when it's failed to close to the downside. However, when I'm as bullish as this and the understanding is there, I then start to look at internal structure. Well, what's it doing on the M5 internal structure? These points are little areas of structure which would actually be the 1 minute, but it's much more clear to see what it's doing on the M5 because the 3 minute and the 1 minute are our entry timeframes. We are not going to create structure and create a bias off this. We're only going to use it to refine our entries. So as you can see, price is trying to move up. It's created an upwards expansion. So I understand that higher time frame structure is bullish. We have an upwards expansion on the ADR model. There are two confluences which I need to build my bias. These are not going to be where I'm going to take my entry. It's not going to be based on what my entry will be, but that is going to create my bias and what I'm going to do for my session. So when we see the breaker structure to the upside, which has taken the high of New York from Friday, we're then looking for the points in the ADR model to take buys from. We want price to respect these points because there has to be some sort of significance to push price back up when it's pulling back down after it has taken a high. So when we go down to the 1 minute, this is where what we are looking for. We are looking for price to be holding and creating a break of structure back to the upside or a change of character, in which I call it. So here on the DR high and the RDI high, price just pushes through. However, on the equilibrium, price pushes a little bit down but respects it. It then creates a change of character. So this here right now creates the bullish intent on the lower time frames to target the previous new created high. So push up, the first thing we look for is the displacement candle. This is a big displacement candle to the downside here. So this is where we'll put our OTE entry model. So where we have it here. We are then looking for an interaction with a 0.62 and the 0.79 area. We do get it here. Just mark it out so it's clear. There we are. So we have it just about here. So when I saw this, I wanted to take buys when it closed back above. So when it did, we took our entry here. We understand that when we get a change of character, this should be the new protected low. This also being the equilibrium of the ADR should give an additional confluence that price should hold, because if it doesn't, then it's either following to the downside or interacting with the low point of the DR. However, we're not going to cover our stop loss that much because it would not make it an efficient risk to reward trade. So we get in here on a market entry. We then see prices just moving around a bit, ranging, and we have a decent impulse. We then get these equal highs put into the market. So at this point, it could be a potential sweep to the fair value gap on the left-hand side if price wanted to continue down. However, price is got a heavy bullish intention on the open at Frankfurt, and then it takes the previous high, which was newly created on the open at London Killzone. So hopefully you can use what I've just shown you from my trade to understand how important structural bias is over just using the DR model. Instead of combining them both, you'll create a much more high probable bias, and then the OTE model will provide much more confirmation for you for when price comes back down. The risk to reward might be slightly less. However, if price is going to come down and just run you out on your limit, you're then going to prevent losses. And that's how I see it. Having more confirmation, there needs to be more of a picture built to get into the market. So I hope you enjoy this. Hopefully this helps and you can use this to go test on your stuff. And I hope you all have a good week. I'll see you in the next